Hey guys, how you doing? I'm here at the RES, just finished concluding the video, but I want to talk about finance, what's going on with the markets. It's been a really crazy time. It is September 8th. Market's been selling off, and people are asking me what is going on. Why does the market sell off? There's a couple of reasons why. First and foremost, there's a growth scare. People think growth is slowing, like Nvidia and Broadcom, which did slow down, which put a lot of pressure because those PEs, price earnings, have expanded. Another thing is a carry trade. There's been free money. There's been this arbitrage where you can borrow money in yen in Japan because the economy is so bad at zero rates, and they take all this money. Hedge funds and Wall Street are investing these funds into real estate and the stock market, bonds, you name it. And now the central bank in Japan now want to raise rates because it's been at zero or negative rates for such a long time. And as they raise rates, the yen will strengthen against the dollar. And all these other people now, let's say the yen's at 160 to the dollar or 150, now it's at 145. Now the situation is that they have to convert their money back, and it's gonna be a situation where they gotta sell their assets because they don't want to be on the other side of it where the yen starts appreciating too much. They'll get margin calls and they're gonna lose a ton of money. So that's why they have to sell stocks and blue chips, and people are thinking why good companies going under is because are selling off is because these hedge funds in Wall Street, typical Wall Street, they're greedy obviously, and they always want to make money, and they have to sell stocks, good positions, and they have to cover those yens, convert those dollars back into yens before the yen appreciates. So it's an arbitrage situation. So my take on the matter now, the markets, I think, are we in a growth scare? Are we in a recession? The jobs numbers don't look so good. Is Jerome Powell going to cut 50 basis points or 25? Who knows? 50 might signal a panic to the market, which will not be good. But that being said, Powell has always been behind. He's always doing things too late, not cutting enough, raising too fast, not cutting fast enough. So that's my take on that. But I tell people, my picks have done pretty well. Bitcoin's done really, really well. A portion of your fund should be in Bitcoin, 1 to 3%, I believe. IWM has done okay as well. We'll see as the market sees value. I think small caps will perform extremely well when interest rates get cut, because those the small companies are the ones that get affected by high interest rates. On top of that, I would say SPY, S&P or NASDAQ, you can hold those positions, which I understand, but I'm really scared for a market crash. I'm not going to be one of those guys that scare everyone and do all those kind of things, but there's a potential. I saw Lifter 2000. Guys, I was financial back in 1998. It was brutal. It was up in the 2000. There's a lot of people who couldn't retire. I had balanced portfolios. I was doing what Merrill Lynch told me to do. And that's pretty much what I did. But balanced portfolio, you still lost money in 2000, 2001, 02. The market rebounded a little bit. And then back in 07, financial crisis, obviously, with Countrywide and AIG going under, getting bailed out by the banks, by the federal government, Bank of America getting bailed out by Warren Buffett, Morgan Stanley getting bailed out by the Japanese. I remember these days. It was scary. 2007 was hella scary. It was crazy. So now I don't know. We don't know when the next shoe's going to drop. Maybe it's a young carry trade, something that we didn't expect is going to happen, and that's what happens to people's retirement accounts. Now, if you're a short-term investor, well, you need the money for a down payment, pay for something, pay for college tuition. It's going to last 1 or 2 years. Obviously, you can't put it in index annuity because index annuity is a 10-year strategy. I tell people, I had friends come up to me, hey, I want to put a couple $100,000 or $500,000 with you, but I want to put out a down payment on a house. I said, this product doesn't work that way. This is a long-term. It's ideally for money that you want to see, and you're going to give it to your family, your kids, pass it down. Or it's a retirement accounts. I do a lot of 403Bs, IRAs, Roth IRAs, rollovers for the most part, and that's what you should be putting those funds in. And if your account has a family who worked at Google and different companies, they got that stock matching, and then he got out, and then he's not going to get affected. His account value will never lose value. So what I've learned in being a financial advising business is that you do not want to lose clients' money. That's rule number 1, and rule number 2, never forget rule number 1. Okay, now. I'll talk about stockbrokers today, financial advisors. Today, financial advisors are all about gathering assets. They're not about knowledge. Go gather assets, go build relationships. And we'll just throw it into a mutual fund manager and they'll manage for us. Or we'll do an allocation, a 20, 30, 24 allocation. But that is horrible. People are getting lazy. I think today, I'll comment below, like a lot of doctors, I've heard this, or just the knowledge is just not there as much as it used to be. It's just, I don't know, there's a lot of shortcuts. And financial advisors, who I speak to a lot of times, they don't know what's going on in the markets. They don't know what's global macro situations. They're kind of more, I'm not saying everyone, I'm just saying a lot of people I talk to, because Wall Street now is like, go gather assets, go have relationships, go network. But that's cool and all, but I talk to people here at Aria, like the guy is his advisor doesn't really know what he's doing. He just puts him in some funds, and that's it. And I'm like, how is he performing against the benchmarks? You have to look at your account, look at the S&P 500, see what it's doing. It's done 8% in the last 20 years. If your account has done less than 8% in 20 years, which 90% of mutual fund managers do, you got to find a better way to get better alpha on your returns. That's what I'm committed to doing for my clients. I'm about performance. If a client leaves me, it's because of a performance. I'm performance based. I'm a nice guy. I'm cordial, all that. But at the end of the day, it's about performance. You should really be crazy about performance. I see people going to Costco to save a few bucks here and, do all these hacks. But in terms of your retirement account, you just have no idea and you don't care, which is crazy. So if you're in a mutual fund, number one, definitely go to jungagency.com or click the description below on my profile and schedule appointments. I can definitely get you better returns probably and save you like 90% in fees. Fees is what kills your returns. People don't realize that. It's not performance, it's fees on top of that too. So bad manager charging 2.8% management fees, and you're averaging 8% 20 years, and your mutual fund company is charging 2.8, and 90% of those managers are not even beating the S&P 500, so you're probably getting 6 or 7, and then you're paying 2.8 in fees. Tony Robbins talks about this, how the mutual fund industry, Wall Street, is terrible. I mean, if you do deep dive into this, you go research yourself how much is the expense fee on a mutual fund, total fees, not just fees. I'm talking trading costs as well. So I don't know, I'm crazy about it. I'm like always looking for returns. I'm looking for alpha in the market, and not everyone's down for that, but that's what I'm crazy about. I'm committed to it. That's why my clients love me. I'm 5-star on Google because of that, because I really take this thing really seriously, and this is my passion, my kind of addiction to get returns from my clients, and that's what I do. And I like to put people on products. I've seen too much pain in 2000, 2007, where people who wanted to retire couldn't retire in their 401ks because they're running out of money. Another thing, and for the most part, a 4%, if you have $1 million, you want to pull out 4% every single year to preserve your wealth so you will never run out of money, okay? 4%, that's kind of how it works, because you're going to do bonds and equities. That's the 4% rule. In index annuity, I did a scenario for a client. They're going to take 5% out, and they'll never run out of their money, and they're still going to have principal appreciation taking 5% because of runs. Because I understand when I was an advisor, you put bonds because you can't have any losses. Losses are terrible for your account. But index annuity, you have a floor of 0. So the market does 15 and does minus 20. You're still up 15% on your account. And then it goes up 15%, goes back up, V-shape. Then you're good. So you're never going to have a down year. You're going to have flat years, but you'll never have a down year. And that's really, really important when you retire. I'm advising all my friends and family and my clients, and it's the world out there. That's why I'm creating this content. I'm committed to it. You might have to see this 100 times to get off your ass, to book an appointment with me, or our advisor that does fixed annuity, indexed annuities, and you're investing indirectly into the stock market, and they use the index for accrediting to credit your accounts. Let's just say you have $500,000, and the index does the Goldman Sachs index or the S&P index or you name it, does 10%. So $50,000 in credit account, 550. Says year 2, market's down 20. Obviously, the index crediting system is negative, so it's 0. So you're still at 550. So you don't lose value. On top of that, this is the ultimate alpha. You get 10% bonus when you roll over your funds, which is insane. And that's for a single premium account. And then your variable premiums, deposit. I have a company that will give you 5% matching for 8 years, which is phenomenal and good performance as well. And these accounts are outperforming the S&P 500 for the last 20 years. I've done all the forecasting and all the modeling. They've outperformed. So, and hey guys, if you're interested in really getting serious about your retirement account, definitely description below, schedule a time, or if you're watching this on TikTok or Instagram or LinkedIn, definitely you can go to jungagency.com or click the link below. But yeah, I'm here committed to helping people. I want to grow my practice, yeah, no doubt about it. But at the same time, I want to help people. And I've been doing this for 30 years. I got off with clients. Like, wow, I'm really blessed that you've been doing this for such a long time. A lot of these new advisors, no knock on them. They've never seen a down market. They've never seen '07. They've never seen 2000. You know, they just don't know. They have not seen it. So you need someone who's very seasoned, who's been in the game for a long, long time. And I was on Wall Street. I was at Merrill Lynch. I learned the ropes. I learned what the wealthy do. So that's just my take. And then IULs as well. I'll do another video on the IULs. People to understand that. Once you understand that, you're going to sign up for one if you're healthy. That's uninterested compounding interest. All right, guys. Hopefully you enjoyed this kind of content. Comment below. Give me some likes. I like to do more financial stuff. That's what I'm committed to as well. So, all right, guys. I'll see you next one.